We'll record this. Yeah. So there we go. Welcome everyone. Dave DeBow and our special presentation today, profitable investing in crazy expensive markets. So it is my pleasure to introduce our two presenters for today. We've got Matthew and Ming from Volition Properties in the GTA in Toronto. And these gentlemen are definitely the real deal. They are active real estate entrepreneurs. They've been doing this for years. They are investing in the GTA and Toronto, so they know all about crazy expensive markets. And it's not just passive investing. These gentlemen are active investors. In fact, Ming, if I'm not mistaken, you've got a real background in construction. So it's not just buying properties, it's renovating properties, fixing properties, maybe even building stuff from the ground up from time to time. And plus, you guys are active realtors. You specialize a lot working with real estate investors who are looking to buy properties and revenue properties. And you guys have been teaching and training around real estate investing for a long time. You got a very, very active group in Toronto. So thank you so much for doing this presentation today.
Oh, it's our pleasure to be here. You make us sound really grand. I hope we can live up to that.
I think you both are grand. So you guys here, I'm going to let you take it away. You do your thing. I'll be here and I'll just turn my video off and mute myself and jump back on towards the end.
Cool. Sounds good.
So let's dive into it. We were telling Dave just before we got started that basically we have, this is typically a one-day course that we teach how to invest in a market like Toronto. But we know obviously we don't have a whole day here, so we tried to whittle it down to 1 hour, just kind of taking the key components. So without further ado, let's dive right into it. So who are we exactly? As Dave mentioned, what the overlying thing that we're trying to be is help people navigate the complex world of real estate investing, especially in places where it's more difficult, like Toronto. You can't just simply buy and rent. That doesn't work. You have to be much more sophisticated investor. So we look to provide a complete solution end to end. We're very heavy on research. As you'll see, we've got a lot of data. And then we take that data, we analyze it, and then we take it one step further and actually synthesize solutions that work against the data that we have. That's us in a nutshell. Next page, please. So we are investors ourselves, as Dave mentioned. We've got a lot of holdings. We've been doing this for a long time, a bunch of awards. This is not to impress you, but to impress upon you that we do come from an area of experience. Next slide, please. Oh, yes. Just a little pat on the back ourselves. We've partnered up with HGTV recently. So right now, if you go to the real estate section of HGTV Canada, we've got a bunch of articles up there.
Four articles right now, and a fifth one I just finished today. So we'll have a fifth one up there soon. Yeah,
Matt always likes to caveat that it caters to a certain audience, so they are very picture heavy and less information heavy. But obviously that's why you come to meetups like Dave's to learn the actual information. But it's still
more specifically what I say is it's very fluffy. And even what it is that I write, their editors whittle it down, and it has to fit within 100 words. I was like, okay, could I really teach real estate in 100 words? But that is kind of the premise of HGTV. But okay,
cool. Let's keep going. So next slide. So this is how we work, because oftentimes people are like, okay, this sounds really interesting. How does Volition work? So the first part is advisory. We teach real estate investing in crazy expensive markets like Toronto. And then our core business is actually helping people buy these properties. We are realtors. So if somebody is looking to buy an investment property in Toronto and the GTA, we do that. Obviously, we do regular stuff as well. It accounts for a big part of our work. And it's nice that you can take those expertise and apply it to regular homes. But really our specialty is that in finding cash flowing properties that allow development, properties that allow Laneway Suites, that kind of stuff within Toronto. Second is, as Dave mentioned, we have a whole renovation and design service branch. So, it's beyond just saying, hey, you could do your kitchen and bathroom here. We can actually come in and do it. This morning I just gave a presentation on an $800,000 renovation, main house plus laneway, massive work that we're doing. So we're accustomed to that level of renovations. We can take you from beginning to end in that space. And lastly, we do leasing and property management. So once you get the property beautifully renovated, now it's time to find the right tenants. We take that on for you as well. So this is us in a nutshell, little team here. Let's flip to the next slide. We're hiring. So every channel you see us on right now, we're mentioning this because we are really trying to find 2 more people, who would be interested in working with us. We're looking for realtors. We don't expect them to be investor experts. We know that this is a weird niche, so we're happy to help out there. And lastly, this is our vision picture. A lot of companies have vision statements, but we have this because when we started investing, it's a messy maze, and a complicated maze too, and a maze that's different for every individual. So we really try to be that eraser in your life and help get you through the complex investing maze.
Okay, good stuff. So the premise of what we're going to be talking about today is obviously why, but also how to invest in crazy expensive markets. We live in Toronto, we invest in Toronto, we help clients to invest in Toronto. So this is going to be very Toronto centric, but a lot of these principles can be expanded to apply to any expensive market. So the question you start off with, or the question that most of our clients start off with when they're approaching us, is they'll say, Toronto is so big, where do you start? Like I hear Toronto is a good place to invest, or my buddy told me I should start investing. What do I do? So we want to take a more systematic and we want to apply a framework when we go about approaching this question. So we're not just approaching it willy-nilly. We want to approach it in a very structured way. So the 5 most how we start is we ask, what are the 5 most important questions when we're investing in Toronto? And the first question, I'm going to try to fly through this as quickly as possible. Normally we spend more time on this, but I'm just going to pull out in a list that highlight some key points. Question number 1 is, where is the economic growth in Toronto? So if you know anything about real estate investing, you'll understand that the economic fundamentals are the key component to what drives real estate. It's not, this other stuff. It's not interest rates, and it's not, whatever else you read in the media. It has to be underpinned by economic fundamentals, and more specifically, economic growth and GDP growth, which leads to things like job growth and population growth and so on and so forth. So when we look at Toronto, and for example, this is a profile of Toronto that employment survey they put out every year. And in the fuller version of the presentation, we've done this and we've gone all the way back to 2014. We don't need to, but we don't need to go through every single one. What you need to take away from this is, where are the jobs? Where are the jobs in Toronto? And the answer is, the jobs are in downtown Toronto. So downtown's job numbers and job growth outpaces that of Toronto. Toronto outpaces that of Ontario, and Ontario outpaces that of Canada in overall. So downtown is really where you need to start to focus. Why? It's because of this concept of return to the core. This article is a little bit dated, but the concept's still there. Even back then, they could see the writing on the wall. Downtown is where the highly skilled, highly educated, and the young population is going to be. It's a lot of the reasons why a lot of these companies are opening offices in downtown Toronto, where traditionally they used to be outside Toronto. A good example is, for example, TELUS. The TELUS building opened up in downtown Toronto because they saw the writing on the wall, and they saw where the future of their workforce, where they were going to be. They were going to be in downtown Toronto. So they moved everyone from Scarborough to downtown Toronto. Okay. Some other interesting tidbits. Downtown's population in about 20 years is projected to almost double, from 240 to 475,000 people. Like that's bonkers, right? That's insane. That's an insane amount of growth. And you just take a look. Downtown accounts for half the GDP in all of Toronto, a third of the jobs, and so on and so forth. But it's only 3% of the land area, and that's why the land itself is so valuable. Yeah, you know, it's the land that's underneath the building is what's valuable, and that's what goes up in value over time. So scarcity of the land is a key component of why Toronto works as well. Big tech, Microsoft, Google, we've heard all this. Big tech opening up major offices in downtown. Yeah. So anyway, let Ming take it from here.
Yeah, you know, I hope Matt's point comes through. It's a universal thing, right? Like if you're, I don't know, a Texas investor, and you want to look at where is the major economic growth happening within Texas, right? Maybe it's Austin, I don't know. But you're looking at those drivers. For us, we're Canadian investors, and that's why we end up focusing here, because we could invest anywhere technically, and we have actually invested all over the country. But when we start to will it back down to these fundamentals, this is where we ended up. So one of the things we like to do at Volition is, you know, I spent many years as part of RAID, and so did Matt, and one of our mentors there, you know, Don Campbell, he loves to look beyond the headlines. That's one of the things, it's definitely one of the teachings I think we both take to heart. So when we look at the data behind where pricing and economic growth is happening, we like to take our own lens to it and gather our own data so we can write our own headlines. So what we did is we actually look at, we captured data postal code by postal code throughout the GTA. And we look at what's called the home price index. So we're looking at like for like properties. What that is let's say it's a 2-bedroom condo, for example. It tracks the price of a 2-bedroom condo month over month versus looking at averages, because averages don't tell us very much. An average home sale price, if there's lots of activity in the condo market, the average home sale price will be lower because condos are cheaper. If there's lots of activity at the high end of the market in, you know, $3 million homes, average home sale price is going to be higher. But what does that actually mean about your individual property? So that's why we like to look at better metrics like the home price index. The next slide, please. So when we look through the downtown core, what we see then, so these are all the trend neighborhoods, and that's basically how our data is segregated. So if you go to the next slide, and this is what we're seeing. You know, everybody had talked about sort of this downturn happening through 2017, and yes, there was a little bit of a downturn through 2017 in the local market here, but the fundamentals have supported a very strong market in this downtown detached properties. It has remained consistent and continued to grow kind of explosively through 2021, but has continued to grow in these neighborhoods. If we look at downtown condos, which is the next slide, we see something similar. There was definitely an impact from things like COVID. COVID itself not impacting the market as much as people looking for more space. But you've seen that, if you'll see at the data here, that the market has completely turned back around in downtown condos now, especially as we're starting to reopen and people are looking to get back into the Toronto market so that way they can be close to their jobs again. Next slide, please. And then when we contrast this to the other neighborhoods, we see something very different. This is why people say real estate is hyper-local. So let's look at, you know, Vaughan's, Richmond Hills, even the outskirts of Toronto, Willowdales, some of those kind of neighborhoods. And it's a very different story. This is single family detached, and you'll see it did peak through 2017, but then it was down through most of 2018, 2019, 2020. So when you were seeing Toronto average prices, it was really a tale of two cities, where you were seeing, you know, downtown continue to grow and expand in price, but uptown not growing at nearly the same sort of rate. So that's why it's really important, not just to be an expert in whatever your city you're investing in, but an expert within the neighborhoods within that city. But yeah, through 2021, also explosive growth in single family detached homes. And then let's go to the next slide. Right. So one of the questions we got a lot of through COVID, like why were we seeing continued growth within Toronto, through the pandemic, when there was all this talk about people leaving major cities. So we did two things. We don't have a slide on this, but we looked at the data behind rents within the city at a postal code by postal code level. And what it actually showed us was people weren't moving out of the city, but they were moving within the city to more space. Because what we were seeing was a massive decline in rents in those small studio condominiums right in the financial district. But people were moving one postal code over, two postal codes over, zip codes for US folks. And they were just looking for more space. And understandably, if you're stuck in lockdown, you're going to try to get more space. And you're willing to move to get that. But you may not want to leave all the amenities of the city that you like. So we weren't seeing much of a drop in rents. And also because of the kind of impact COVID had, unfortunately, it was very impactful to blue collar workers and blue collar economy. And to be quite blunt, that was never the Toronto buyer to begin with. Homes are expensive here, and they have been expensive for a very long time. They may potentially be your rent profile, but people who are buying homes, especially within the city, are all quite well-heeled, typically white-collar workers. And there was actually job growth happening throughout the pandemic in white-collar jobs.
Cool. So that leads us to our next question. Who are the customers for my business? So make no mistake, as real estate investors, we're running a business. So we need to be thinking about who we're targeting, and the customers for our business are obviously our renters. And the question is, who are our renters? With the Volition business model focused in Toronto, and more specifically downtown Toronto, we target a professional millennial, and I'm going to extend the definition of millennial to also include Gen Z, because the oldest of the Gen Zs are starting to come up through the ranks now. Why? Millennials, and now Gen Z, they are the largest demographic to come through since the baby boomers. They have changed the face of the baby boomers changed the face of almost every industry, and millennials are starting to come do the same. So they're the largest rental cohort that you're going to be addressing, and you want to be very specific on who you want to target within that cohort. So who we've targeted are responsible, university educated, people with well-paying jobs, employed in a professional capacity, white collar. These people are, they are quite frankly the best tenant profile. They take care of their places, and they like nice places, and they're willing to pay for it. Sorry, Ming, you're saying?
No, I actually think I lumped Matt with my slide. So I was just looking at this. I was like, oh, avocado toast. I think that was me supposed to speak to this. Anyway, we poking fun at millennials with their avocado toast, but Matt's exactly correct. Like a lot of times people are looking at the property and then figuring out the tenant, and that's the wrong way to do it. As a business model, as a business, you don't design the product and then figure out who you're going to sell it to, right? You're trying to figure out what is your customer, what do they need, and how can you fill that before you go and create a product. And investing is no different. So in the later section, we actually talk about how we take a risk-based approach to figuring out what the best tenant profile is. This is a day-long seminar, but so to cut it down, the answer is millennials, Gen Z, basically people in their early 20s, mid 20s to kind of early 30s is what we're looking for. They are, if you flip to the next slide, we did a bunch of research on these people. So if we want this tenant profile, where do they want to live, right? Instead of I'm buying here and then trying to find this tenant profile. So let's work backwards. if we want a millennial, they want live, work, play neighborhoods. In Toronto, they don't want any more than a 35-minute commute to their jobs. If they start going past 35 minutes, they rather live in a smaller place closer than have to have a longer commute time. Very different from my generation. I'm a Gen Xer. Commuting was like part of our thing. And this is one of the differences we see with this generation. They're less tolerant of a long commute. Jobs, professionals, tech, finance, healthcare, they're knowledge workers. This was also really key during the pandemic for us. I'd love to say it was our brilliant intuition, but we did luck out a bit here in that our tenant profiles are all knowledge workers. So when May 1st came along and, there was a moratorium on rents and, you couldn't kick people out anymore, out of the almost 300 or 400, maybe even 500 units that our investors represent now, we only had one person who was not able to pay their rents. And it's primarily because they were knowledge workers. So their jobs all remained the same. And they just, instead of going to the office, they stayed at home. So that was really key for us. Next slide, please. So as I mentioned, what kind of properties do they want to live in? They want nice places, good finishes, stainless steel. Wi-Fi is super important, especially now with working from home. Another thing I'd add on to this is work from home spaces. Those tiny, studio apartments or awful basements just don't work anymore. And they won't work for a while, even after the pandemic is long gone, because trust me, people are not going to forget about being stuck in their home day after day after day. So even if they have to go into the office, even that becomes a regular thing for them, they're going to want dedicated work from home spaces and outdoor spaces. So that becomes very important for this demographic. Next slide.
Okay, that's the end. Actually, thanks for you're right. You were supposed to do this section, so my apologies for hijacking you. But actually, there's one thing I just want to call out, and again, this is because we're local to Toronto, we're local to Ontario. One of the things that, just flipping back, one of the things very, very important to us is this last point here. This tenant profile is inherently transient, meaning that they're not going to stick around forever. These guys are, in their 20-somethings. They want a nice place to live now, but they're going to move on eventually. And typically, they don't stay longer than 18 to 24 months. Why this is important? In Ontario specifically, and this is why it's important to be an expert in your jurisdiction or your area. In Ontario specifically, we have very draconian landlord-tenant laws that are heavily favored towards the tenant, meaning that we can only raise rent by a certain predetermined percentage every year according to the schedule that the province of Ontario releases every year. So that's like 1.8%, 2%, 0%. So in a place like Toronto, the problem that this creates is that rents, street rents or market rents, start going through the roof, which rising at anywhere from 5 to 10% per year. And if you're stuck in a very limited capacity or ability to raise rents, you're going to start falling behind, and you're not going to be able to maximize the usage of your property because you can't charge highest rents until tenant turnover. So the question remains then, how do you get those higher rents? And this is where you start hearing about things like renovictions, and these big tenant advocacy groups start getting involved. We bypass all of that by just focusing on a inherently transient tenant profile right from the get-go.
Yeah. And this goes back, you'll see it says, we'll talk about it in the time section. It's an area that we have identified all the major risks in investing and how to come up with risk mitigation strategies. So that'll be a little later on in the presentation.
Cool. I think we need to speed up, Ming. So
I know, I just looked at the time.
Okay, question 3. So again, this is a full day seminar, so full day masterclass. Question 3, who are the buyers and where are they buying? These young people who were renters typically wanted to live in downtown Toronto, but as they start growing up, they start getting married, they start having kids, Where do they go? I can tell you where they're not going. They're not moving out to the burbs anymore. I mean, let's just say pre-pandemic, they weren't moving out to the burbs anymore because their life was in downtown Toronto. They had established their life, all the amenities, all the places they go out to eat, all their friends, close to work. So what do? They purchase homes in residential areas in proximity to downtown Toronto. And what that really was the Annex, Little Italy, Trinity Bellwoods, Riverdale, Leslieville for Toronto. And what they're doing is they're buying these old grandma homes and fixing them up. So tons of gentrification and renovations are happening in these areas so that they can still stick and live in the areas that they were most accustomed to. And then, part of the new trend was also putting in basement suites as mortgage helpers, so that they could afford these really expensive homes in downtown Toronto. So that's all to say, this is all in an effort to demonstrate why downtown Toronto is the place to invest. Okay.
Yeah, because often we get asked, like, why are you even looking at really expensive markets? And this is a big reason why we're, because we actually have invested in places like Edmonton, Hamilton, and stuff like that before. So this is the reasoning behind our thought process. So next slide. What type of asset should I buy? So if you're, not very sophisticated investor, you think in Toronto, the first thing that comes to mind is a condo. But I know Dave's audience, you guys aren't newbie investors, you're a little more sophisticated than that. Obviously, condo does not cash flow, right? Certain pre-con construction projects occasionally make sense because you can cash flow upon acquisition, but that they're few and far between. And we haven't had really one that may have made sense in about a year and a half now. Also, that's not where property values go up, right? We all know that the value of the property is not in the building itself, but the land underneath it. So if you go to the next slide, we want to get into the houses, right? That has, instead of fractional land ownership, we want to get into full land ownership. So this is not new news to anybody here, but the question is how? How do you do that in a city that's so expensive when, when properties themselves are so expensive? So next slide, please.
Okay, cool. So the question that we also get is, what is the single most desirable feature that will help me determine where to buy? And so this will now illustrate and answer some of your questions. So this is a map of Toronto, right? And this is my rudimentary Microsoft Paint skills that illustrate where all the transit lines are. So the transit lines, transit is the answer. Transit is the single most desirable feature to help you determine where to buy. And in fact, rewind, I don't know, a month or a month and a half, we actually delivered a presentation on Toronto's next hottest neighborhood. And it was heavily based on future transit stations, just to drive home that point. So here are all the transit lines in Toronto. And so this is, again, Ming and I came up through the ranks through RAIN, a lot of respect for RAIN. And RAIN used to release a report on transportation and the transportation effect. It is literally the single most important thing to look for when looking at where to invest. So that's worth a read if you're interested in Toronto. But I mapped it out here for you, and this now becomes the Rosetta Stone or investment heat map around where to invest. These, if you know Toronto, you'll know that these areas, the dollar signs, are super expensive, anywhere from like Forest Hill to Leaside, down through Yorkville. It's like some of these places just don't make any sense, right? Even though they're on transit lines. So transit is not the only answer. It's one key component of where to invest. The best places to invest end up being where we have in red. So west side of Toronto, east side of Toronto, around transit lines, dedicated transit lines. This includes Annex and Little Italy and Trinity Bellwoods. Over here is your Leslievilles and East York. So how does COVID impact where and what you should buy? Sorry, I normally spend more time on this, but just in the interest of time, I'm trying to get through this. People will be back in the office after COVID, but they won't be back to usual. So, I mean, as Ming's already kind of touched upon this. So when you're thinking about where and what to buy, we need to start thinking, expanding our criteria and broaden our thinking a little bit in terms of what is it that our renters want. They've already told us, because we're so active in the market, we hear boots on the ground from prospective tenants what they're looking for. Some of the highlights: they still want access to public transit because they don't have cars, and they're not planning to have cars. So access to transit and ride sharing is still important. Access to the outdoors and access to outdoor space. So those things could be patios, it could be backyards, but they want to be able to have outdoor space, to have a few friends over if they can't necessarily have those friends inside. Access to more space, being like more square footage and more dedicated home office space as well. The office nook, maybe an actual office or a den, something to that effect, where someone can comfortably work from home.
Cool. Let's keep going.
All right.
Okay. So this is how we look at investing, as opposed to just looking at, hey, what are the financials are? What's the return? Looking, because I worked in finance for many years, looking at what is the risk and how do we develop a risk-based approach to our investing. So it comes up, turns into a nice little acronym, which we like to use. So if you want to skip down 2 slides, Matt, it works out to time, right? So time, one more slide.
Sorry.
So it works out to time, the acronym. And these are the major 4 areas of risks that we see. So T, tenant risk, that's the risk of getting a bad tenant, and also the risk that the framework that we have to work around. Matt mentioned we have laws in Ontario that are very tenant friendly. So the risk of a tenant is much higher here, because if we get a bad tenant, it's very hard to kick them out. Next one is investor risk. That's the risk that you bring, right? If you're a knowledgeable investor, your risk is lower. And hopefully you're listening to podcasts, like Dave's podcast, you're getting yourself educated, come out to our meetups too, but get yourself as educated as you can to mitigate that risk. The other one's market risk. We talked a lot about how to mitigate market risk by making sure you're buying in areas of economic growth. And the last one's estate risk. And this is inherent to the property, the exact location, the kind of property you're buying. If you want to do triplex plus laneway, there's risk around being able to do that on the individual property. So this is basically the 4 major areas that we're looking at. So the first one we're going to touch on, if you go to the next slide, is tenant risk. And as I mentioned, this is basically how we see Ontario's particular tenant risk. It's the most risky part, and our whole business model, it shifts and becomes a lot more focused on finding great tenants. This could be very different if you're investing in, let's say, Alberta, right? Where laws are a little more tenant friendly. Tenant risk isn't going to be as difficult. So make sure that you're balancing what your risk mitigation plans are for your particular market. Let's go to the next slide. Yeah, so as I said, tenant risks, we target millennials because for us, they're the less risky. And we already touched on the transient part. We actually want them moving every, year and a half, 2 years. Next slide. Next one's investor risk. I won't go too much into this, but get yourself educated. That is the most important thing, because an uneducated investor brings a lot of their own risk. The other thing is to establish a team. We have the super friends here because, you are the CEO of a company, and no CEO would try to do everything themselves. They have to become experts at their business, so you have to become experts investors. But you want to have, the best investor real estate agent, the best investor focused, lawyer, accountant. If you want to understand JVing, because that's part of your strategy, you want to be talking to Dave. So you have, the best person to be able to help you out in that area. It's very important to hire the best. That is your team. Those are your employees, essentially. Next slide. Market risk. we touched on this quickly already, but this is basically, we want a diverse economy, no single jobs, single industries. We're looking for diverse job growth across multiple different types of industries. Next slide. Places that are popular for immigration, right? We know today that 35% of all immigrants that come to Canada end up settling in the GTA. That's incredible, especially because we're talking about 400,000 people coming into the city, coming into Canada once we open our doors up, after the pandemic's done. That's going to be population growth. That means lower vacancy rates. That means, lower caps, which is great once you acquire properties. Let's hit the next slide then. The last one's actually the estate risk itself. So are you buying the right investment property? Because vast majority don't work, right? Just like, people think pre-con as a way to get into the market. Yes, but when we do our analysis, one hasn't worked for a year and a half, right? Our bar is very high on what actually makes sense as an investment property, and so should yours, right? You should be writing 10 deals for every one deal that you actually do, because your bar should be high on what actually works. And here we say you can't just say Toronto, you have to be specific. You can't say any market, Edmonton, Hamilton, if you're in California, LA, like it's no good. The cities are so diverse, and you have to be a neighborhood by neighborhood expert. Next slide. And really, one of the things we'll talk about later when we get into cash flow and how it works in the city is some of these other points. So things that are important in neighborhood: gentrification, transit infrastructure, tenant profiles. These are all things, if you're looking to do development, what side setback requirements, laneway access, minimum ceiling heights, it's often overlooked how important the actual property is when you're looking to buy an investment property. People just look at, hey, does it cash flow? And then if it does, it gets the check mark. But that's fine if your business model is that simple. But in a complex, more challenging market like Toronto, it can't be that simple. You need to make sure that you can do things like have a laneway suite, because those can drastically affect your economics and favorably. But not every property can have a laneway suite, even if you have a laneway at the back. So it's really important to make sure that you're buying the exact right property to execute against your business plan. Okay, role of cash flow. So a lot of people start out like this. And this is where I was when I first heard about real estate investing like 20 years ago. And that's a simple concept of buy low, sell high. Everybody understands that. Let's go on to the next slide. But then you get a little bit of education, and people are like, oh, I understand the concept of cash flow, because it's an easier concept to understand. Every month you make a bit of money because your expenses are lower than your income, and the delta is your cash flow. And investors get into this mindset where cash flow is king. And unfortunately, invest cash flow focused to the detriment of anything else. And a lot of investors kind of stop their mindset growth here. So let's go on to the next slide. What I'm hoping to get people today is understanding the role of cash flow. Don't get me wrong, cash flow is absolutely very important when investing and absolutely necessary, but it is part of your investment and is part of your overall returns. It's not the only return that you're getting. So let's dive into this a little bit further then. So one of the things that was very apparent to me when I started becoming, more sophisticated real estate investor, I remember talking with a friend, saying, oh, I got this place, it's going to cash flow, $200 more than average. That must be amazing. And my friend turned to me and was basically like, so great, you're going to retire now? And it was harsh criticism, but it's absolutely true. Doubling your cash flow oftentimes doesn't do anything. It doesn't change your life. Maybe you're buying some more dinners or whatever happens to be, but you're not retiring over even doubling your cash flow. So what is the purpose of cash flow? When does it actually matter? What is it good for? Cash flow lets us hold for the long term, right? That's what's important. The money is not made on cash flow, but the money is made on mortgage pay down and appreciation of your property over time. A couple $100 a month frankly doesn't make a damn difference to your life. For most people, it doesn't. So you need to be in there for the long term. And that's where cash flow really makes a difference, because if you have a cash flow negative property, you can't do that for the long term. And you can't scale on that either. You don't want to go from a business of negative $200 cash flow to a business of negative $2,000 cash flow. That's not good. So you do need it, but you need it to let you hold for the long term. Next slide. So cash flow and in just general cap rates are lower because it's less risky. You get into major markets, New York, London, Toronto, Vancouver, any of these major cities, cap rates are always lower. Why? Because cap rate is a function of risk. It is telling you that the market is less risky. Therefore, I'm going to give you less cash on cash return. So cash flow is less in Toronto because it's less risky. It's more diverse. There's better economy, more infrastructure investment. Next slide. So one of the things I like to throw out is, like, if you could choose between $2,000 in cash flow and 5% appreciation, or 7% appreciation and $500 cash flow, which actually nets you better return. So we're talking about 2% more appreciation or 4 times the amount of cash flow. So this is an analysis over a 25-year period. Not to dive into all the details, but basically your final equity in this property is about $4.4 million on a $1 million asset today at 5%. We go to 7%, and we're looking at significantly more, almost $6 million in final equity. Next slide. That nets us a almost $1.5 million difference in those two scenarios. So this is why just a little bit more appreciation is so important. And that's one of the reasons why we invest in major markets. So when do you really need cash flow? It's important, but not at the expense of all else, right? Buying in the right neighborhoods where there's good infrastructure and job growth is far, far more important than eking out a little bit more cash flow. And when it really matters is at the end. Most of us have jobs where even if we're getting another $1,000 a month, we can't reduce our income or reduce our time by $1,000. So when cash flow really matters is when you're at the end and you're looking to retire and flip everything over to cash flow. So how do you get to the end? Next slide.
Yeah, so getting to the end for our clients usually means employing the volition multiplier effect. So, I'm going to gloss over this pretty quickly. We've whittled down a lot of slides, but this is a more sophisticated audience, so I don't need to teach you about refinancing. But the concept here and what I want to contrast is the idea of buying one and waiting 25 years or 30 years, or employing the multiplier effect. And the reason I want to demonstrate this is I want to show how the multiplier effect works in Toronto and how Toronto actually supports the multiplier effect. So a realistic Toronto example, let's say you have a $1.4 million triplex, $6,000 in rent and $1,200 in expenses. And let's just say, for all intents and purposes, it's minimal or zero cash flow. Let's just say we recycle all the money back into the property. So Toronto currently has been sitting at anywhere from about a 7 to a 10% growth rate, and rents are actually about 5 to 7%. But I'm on the conservative side, which is 4% and 4% growth on expenses as well. The idea here is, you in a higher growth market, in a crazy expensive market, let's call it, you have the opportunity to buy a property, wait at 10% growth. You only need to wait about 2.5 years before you've built up enough equity in that property through appreciation and through mortgage paydown to refinance, do an equity takeout, and go buy another like property. So in 2.5 years, you can actually go 1 to 2, and then another 2.5 years, you can go 2 to 4. In another 2.5 years, you can go 4 to 8. Then what we do, the Volition approach, is to wait until we hit about 50% loan to value, and then we start divesting. So that takes about 4 years to get to 50% loan to value, and then we sell off half of our portfolio and pay off the mortgages of the other half. So let's see what that looks like. So this is the power of the multiplier effect, specifically in Toronto. But again, this will work. It's an extensible approach, and you can use this type of framework and thinking to other markets as well, other crazy expensive markets. Simple approach. Imagine that you bought one, you waited 30 years and a 10% growth. Let's just say that was sustained. You would end up with one property in 30 years that was worth about 17.5 million. You'd have about 19,400 in rent. Your expenses would be 3,900, and you'd have about 15,500 in cash flow for about 186,000 of positive cash flow annually in 30 years. So let's look at the Volition approach, where we've grown our portfolio from 1 to 2, 2 to 4, 4 to 8, and then we waited 4 years, and then we sold off half. We're left with 4. Each one of those. So the overall, this takes 11 and a half years to do instead of 30 years. So each one of those properties is worth $3 million. So you have a $12 million portfolio. Rents are $9,400. So that's $37,600 across the 4 properties. Expenses is about $7,600 across those 4 properties. Again, zero mortgage because you paid them off. And that means $30,000 of positive cash flow. So annually, $360,000 of positive cash flow. We have 2 times the cash flow, and we've achieved that in 1/3 the time. This is the reason we invest in these types of markets. In slower growth, smaller markets, you don't have that opportunity because you don't have that type of growth. You might have better cash flow, you have better cash on cash. You would actually need to scale your property, scale your portfolio. If you made $200 positive cash flow or something like that, in order for me to make this type of money, I'd have to scale my portfolio to have 50 of those properties or 100 or something to that effect. So all to illustrate the point of how to invest in Toronto and how to employ the multiplier effect to maximize your return and minimize the amount of time it takes you to get to this point. Cool?
Great.
Okay, so then it now begs the question, what do I buy? So in Toronto, you've got the pre-construction condo, right? So I won't go through all of this, but generally speaking, you know what pre-construction condos are. They're great in some regards, they're not great in other regards. Generally speaking, a favorable deposit structure, it solves some short-term mortgage qualification problems. No headache because there's literally nothing, just a piece of paper. But you can't get rent in the short term. So condo. Regular condo, resale condo. In Toronto, an entry-level condo will be $150,000. Again, you can in downtown Toronto, you'll get the best tenant profile. It's not quite the same in headache-wise because even though you've got a great tenant, you actually have a unit you have to manage now. So we recognize the entry point for a lot of people. We also recognize that our goal though is to get to land. So we often use condos and or pre-construction condos as a stepping stone to bigger and better things. Now, what are those bigger and better things? It's getting to land. It's getting to ground-oriented units. The land is what's valuable, not the box in the sky, right? So an entry-level duplex or triplex in Toronto, in Ontario specifically, we call duplexes when there's 2 units. I know in other areas, duplexes can be side by side. So let's look at 2 half duplexes. So when I'm talking about duplexes, I'm talking about 2 units in one building. A triplex is 3 units in one building. This is our most basic asset if you want to buy a house, you want to own land. You can get it in the residential neighborhoods that surround downtown Toronto. You can still attain a fantastic tenant profile. And this is kind of the building block to building your portfolio. If you want to start stepping up into stuff that's a little more sophisticated, you can buy a house and you can actually add that basement suite yourself. So, you'd have to know how to do renovations or hire a good contractor, hire a good team. But then the positive here is that you actually get a little bit of the reno equity lift yourself as well. So a lot of people will do this. You can even employ this strategy using your personal residence. Obviously, a lot of people do this as use this as a mortgage helper. So because of the renos and the additional unit, you have a better cash flow for the property as well. Now we're stepping up into the big stuff. So this is what a lot of our clients do if they have the capital and mortgage qualification, because the returns are far outweigh. And also you can now attract the absolute best tenant profile, because these are literally condo replacements, condo alternatives. The finishes are amazing. These are gorgeous apartments. They're places that I'd love to live in, right? So you attract the absolute top tenant profile, but your short-term headache, it's a big headache. These are massive renovations. You're acquiring a $1.3 to $1.5 million property and then putting anywhere from a $500,000 to a $1.x million reno to make this into a legal luxury triplex. It takes anywhere from 12 to 16 months. There's tons of approvals you have to go through. In Toronto, you have to go to the Committee of Adjustments. Architects are involved, and it's a very long, drawn-out process. But if you have the wherewithal, or if you've got a good team to execute on this, this is a fantastic type of investment. And then the last one is a tack-on. The reason I call it a tack-on is because you can tack it on to any one of these other ones as long as you have a laneway and the property supports a laneway suite. You can stick it on an entry-level multi or a house where you put in the basement suite, or even a legal triplex or legal fourplex or legal fiveplex conversion. This is a great way to boost cash flow on your property, but it's tricky. The reason it's great is because your land basis is zero, presumably. Presumably you're buying a property, and that property, or maybe you already have a property in which the land basis is truly zero. It costs about $400,000 to $500,000 to build one of these, but you can get anywhere from $35,000 to $4,000 to $4,500 in rent. So if you do the math, you'll see that there's actually nothing else in the Toronto market that allows you to have that type of rent for that type of investment. The tricky thing here is financing. So banks right now, lenders in general, don't know how to finance these. They don't know how to provide the construction financing for it. They don't know how to help you refinance afterward to get the equity back out. That's where it's tough. Lenders are catching up, but they're still at least 6 to 12 months away from this being mainstream. That said, it's probably going to take you that long to build one of these things anyway. It takes about 12 months, 6 months for the planning process and 6 months for the build. But the idea here is that you want to have foresight. So now that we're considering Laneway Suites, and Laneway Suites are a fantastic way to invest, we need to have the foresight to be thinking about buying land for Laneway Housing potential, whether or not you're going to do it right away or not. Does that make sense? So what do I buy? That's the question we always get. The answer is, it depends. One size does not fit all. If you have all the money in the world, then we would say, yeah, let's go for a legal luxury triplex conversion or legal luxury fourplex conversion, or even a fiveplex conversion. And let's go build that Laneway suite. So, we could be buying something in the 1.6 to 1.8 range, putting $1.5 million of renos in and turning this into a $4 million plus property that, qualifying for a mortgage now. You're definitely not into residential financing anymore. You're into probably commercial financing on the refi, higher rates and all the other stuff that comes along with commercial financing. But even after you refinance that asset, take out a bunch of that equity, you're still having a cash flow positive asset. And you created a whole bunch of equity lift as well. So, and then conversely, if you only have, it's funny I say only, but only have about $350,000 to invest, we would probably get you into a $1.2 to $1.4 million triplex. Cool. So we want
Dive
to.
into-
Yep. So go ahead. Go ahead.
I was going to say, let's dive into the case studies.
Yeah, let's
is
do this.
actually like how we apply this in Toronto. So the first one is a fourplex and kind of expensive, to be frank. It doesn't have to be this. I'd say that triplexes can start as low as like 1 to 1.1 within the city. And then you can get up into properties like this, which are turnkey fourplexes. This was close to 1.9. But it works out, and it works out very well. So next slide, please. Some pretty pictures. This was our first HGTV feature. So
Oh yeah, that's right.
yeah. So but go back to the transit slide. Like, this is something that was very important to us. I think we didn't call it out, but specifically, we don't want to be any more than about 1 kilometer away from major transit. This is 850 meters. This is the kind of analysis we do on any property that we're looking to purchase. So 10-minute walk. So that fits our demographic. It fits what we're looking for in terms of public transit access. So next slide then. So these are monthly rents, and I'd say they're a bit conservative, especially now, because this property was right in the middle of COVID when our client closed on this one. So these were COVID rents at the time. So they're improved from here, but you can look anywhere between $9,000 and $10,000 in rent on a place like this. Mortgage payment, this was done at 2.45. So if you want to age where this was, obviously interest rates are considerably better now. But even with the lower rents and higher interest rates, we were looking at about $1,600 in cash flow on a turnkey property. Like, you buy this, you just move people in, you're done.
Yeah.
So these do exist in the city. Very hard to find, but they do exist, and it's what we specialize in.
And this was our client. We helped them buy this property about 4 years ago, and then she ended up wanting to move out of the city. So she asked us to list this, and we found the buyer too. So we have
This is all done off market.
Yeah, this is a pocket listing.
Yeah, this is all done.
Cool. All right. Okay. Anyway, just more numbers, more analysis. You guys are sophisticated enough to know what these are. So, but the next one. So finding the highest and best use to maximize your ROI. So this is a little bit of what I was talking about before. So it's hard to invest in Toronto. Like this, the previous example, unique, I'd say. To find $2,000 of positive cash flow, they do exist. We do help our clients find them, but they are far and few between. But generally speaking, cash flow is not quite as high as they are in smaller city centers where stuff is cheaper. Everyone knows that. We've talked about that. We've talked about the reasons why that's the case throughout this presentation. With limited cash flow, how do we do better? So Laneway Suites are the answer. So the challenges of Laneway Suite conversions, like, this is not for the faint of heart. Like, this is not a simple process. You have to adhere to a lot of municipal bylaws and fire codes. You need to be a certain distance from fire hydrants. You have to have certain setbacks. From the rear laneway. You have to understand things like angled planes, and it's extremely, extremely complicated. And you need a good advisory team to help you navigate this. With Toronto pushing through a municipal bylaw allowing Laneway Suites to be built as of right without having to go to the Committee of Adjustments and without having to go to OMB or TLAB, now there's a huge focus on Laneway Suites, and so you're now paying a premium on lots that are suitable for Laneway Suite conversions. Stuff's really expensive right now. The cost of construction has gone up considerably as well. So that's one of the things we want to call out. Is it worth it? We do think so. So this is an example of a property one of our clients bought. It was 1.5 million, and the idea is going to turn into a legal luxury triplex plus a laneway conversion. 1.5 million, $300,000 down payment plus 60 in closing costs. We've got these crazy ass land transfer taxes here in Toronto that amount to almost 60,000 on this purchase, and this was about a $1 million reno. So you turn it into a triplex. The second floor, third floor on the main house, 3-bedroom, 2-bath would rent for $3,500. The main floor is a 2-bedroom, 2-bath, rent for $2,700. And the basement, 2-bedroom, 2-bath, we could rent for $2,200. And the laneway, we could rent for which is a 3-bedroom, 2-bath, we could rent for about $4,000. So your rents are about $12,400. With mortgage, and I referred to this earlier, you may want to consider, if your own mortgage qualification doesn't allow you to get these types of mortgages, you may want to consider commercial, switching over to commercial. So in this case, the exit was a refi using a commercial mortgage, slightly higher rates, 3.5%, 30-year amortization still on the commercial, ends up being about a $9,000 mortgage. After increased property taxes, hydro is pushed onto the tenants. All these are separately metered. So just water and waste is $200, water $200, waste is about $400, and insurance is about $300. So this is a positive cash flow property by about $2,100. But this is about a 16-month project as well, and very massive project. So let's get into the summary of the financials. As I mentioned, $1.5 million purchase price, $300,000 down payment, which means the mortgage, initial 80% loan to value, residential mortgage 80%, was a $1.2 million mortgage. Closing costs and land transfer tax was $60,000, and your renovation was about $1 million budget, and it was 16 months. So over the course of 16 months, carrying this $1.2 million mortgage and the other expenses is about a $90,000 carry cost. So if you add up all of what got invested in this project, it was $1.45 million of capital, because this client didn't finance the reno. He financed the reno in cash. The ARV, the after repaired value of this property was about $2.9 million. Really, that's super conservative. This is easily a $3 million plus, low $3 million plus ARV. But for the purposes of the mortgage, it was $2.9 million appraisal, and they took a 70%, roughly about 70% loan to value. That's as you probably know, that's not how commercial financing works. I'm glossing over it, but more specifically, it was on an income approach using DCR. I think the DCR was probably around 1.15 or 1.18. So that's how they got to max mortgage qualification and $2 million on a commercial mortgage. But they got an $840,000 equity takeout. So it largely almost covered the cost of the renos, meaning that the net invested capital was about $600,000 for this project, for an asset that was worth about over $3 million. So this is how you actually take your money and make it go much, much further. If it's higher price tag, it's more dollars, but even though it's maybe 2 or 3x the amount of capital than a regular project, you're not getting the same ROI. You actually get a higher ROI. So that your ROI is actually growing exponentially. It's not just growing in a linear fashion. So if we estimate ROIs for regular turnkey triplexes at roughly 30%, assuming a 5% growth rate, these far outpace that into the 50, 60, 70% annualized returns. So I see Dave popping back up, which means I'm out of time, overtime. But anyway, just the last thing. So if you found this interesting, you have an opportunity to reach out to us and link up with us and sign up for a complimentary advisory session. Reach out to us at info@volitionprop.com to schedule something with us. If you specifically are interested in Toronto, that is where our expertise lies. And if you are so inclined, we're doing our next meetup. We run the largest real estate investor meetup in Toronto with over 3,100 members. And we're meeting up in person for the first time next week. First time in a year and a half. I've been
Not
presenting.
3,100 of us.
No. It's not 3,100 of us. You would normally, for normal meetups, we get about 100, 150. I thought maybe 50 or 60 will come out. A fun crowd. Socially distanced, of course. But come out, RSVP and come out if you're in Toronto. I think that's all we got.
Fantastic.
So, yeah.
You guys, that was a fantastic presentation. Thank you very much. I'll give you a round of applause. You can't hear everybody else in Zoom land and whatnot. Brilliant presentation. Thanks for taking a full day thing and condensing it for us. I know how much work that could be, and you did a great job.
This is the fastest that we delivered this. This was this was 8 hours, 6 or 8 hours of content. I think that we.
But you know what? It really gave people a good overview of the big picture ideas. So thank you so much for explaining. Even though we've got a more advanced group, it's always nice to simplify it. Like I call that Reader's Digest level. So the fact that you guys are really able to explain the big benefits of investing in crazy expensive markets, the fact that you guys are able to explain the different investment classes of properties that people typically go through, starting with pre-construction condos being usually the first kick of the can, and then actual condos, and then the different stages. I found that to be very, very helpful, as well as different amounts required for these kind of investments, the pros, the cons, the categorization, the A through F of that. So you guys, great. I really appreciate that. And folks, if you are interested, go ahead, Matthew, if you don't mind, put up that last screen where you got your contact information.
Sure.
We'll include that as well. You guys, if you are in the GTA or anywhere near Toronto, make sure you check these guys out, join their meetup. They have a fantastic group of very active real estate investors in and around the GTA. These guys don't just, sell you properties. They actually do the stuff themselves. So it's not just them looking for new people to sell properties to or get listings. This is a very, very holistic approach, which is one of the things I love about you guys, is you're a full service outfit. Like you name it, you guys can help people out with it. And it's not just theoretical. You actually do this stuff. You actually have the experience, doing these kind of conversions, building these laneway, additions and this kind of things, which I haven't done it, but I believe you 120% that it's a horrendous pain in the ass when you've never done it before, especially when you've never done it before. So
we've done a lot of experimentation with ourselves, for better or for worse. So
well, thanks for those kind words. And yes, like I do think that we fill a niche, specifically in the Toronto market. Very few people know how to invest in Toronto, and most people who think that they're investing, they're not really investing, they're gambling.
Yeah,
right? They're speculating, and when you're going, we had a lot of clients who we've helped them restructure their portfolios because they started, they were pretty sophisticated individuals, but they just weren't educated on the investment front. So they were buying $1.5 million bungalows in Willowdale that would give you $3,000 in rent. And it was because, they thought, but it went up $300,000, and, I was cash flow negative by $1,500 every month, but it went up $300,000. I said, yeah, that's great. But that's no different than going and betting on black, right?
Yeah.
Like you're really putting yourself at risk here. So, over time, we helped him restructure his portfolio into a more sustainable approach, risk mitigated, better tenant profile, and cash flowing.
Well, that's the other thing I appreciate so much about your presentation, you guys, is how much work you've put into and research you put into defining your ideal tenant profile. And like you said, so wise, start there, find the right properties for those guys instead of finding the property and trying to squish the right tenant into it. That is absolutely spot on. Very, very smart. I've had to learn that lesson the hard way a couple of times myself. So you guys, thank you so much. Really appreciate this. And folks, if you're watching this, reach out to the Volition Property people if you're interested in investing in Toronto. This is definitely a good resource for you. And hopefully, if you're not interested in investing in Toronto, but you are interested in higher price markets, this gives you a something to ponder and a place to get started with. So gentlemen, thank you so much. I appreciate it.
Thanks, Dave. It was a pleasure.
Thanks very much.
All right,
Dave.
Ming, thanks, buddy. All right, you guys, take care. Thanks for being on this, and we'll see you soon. Bye-bye.
Take care. Bye-bye.
Bye-bye.